Welcome to Echo 315, Study Session 9, Discounted Cash Flow Methods of Investment Appraisal. Introduction. In this study session, we'll examine the discounted cash flow methods, which are net present value and the internal rate of return methods. Learning outcomes. When you have studied this study session, you should be able to 1. Explain net present value as a means of investment appraisal. 2. Discuss the advantages and disadvantages of internal rate of return. 3. Point out the cash flow that should be taken into consideration in capital investment appraisal. Net present value. The net present value is the value obtained by discounting all cash outflows and inflows of an investment opportunity by a chosen rate of return. The NVP valuation method requires estimating the size and timing of all the incremental cash flows from the project. These future cash flows are then discounted to determine their present value. If we treat outflows of the project as negatives and inflows as positive, the net present value of the project is the sum of all the PVs of all flows that arise as a result of doing the project. The NPV decision rule is to accept all positive NPV projects in an unconstrained environment, or if projects are mutually exclusive, accept the one with the highest NPV. If NPV is negative, the project is not financially viable. If the NPV is 0, the project just breaks even. The NPV is greatly affected by the discount rate, so selecting the proper rate is critical to making the right decision. The hurdle rate is the minimum acceptable return on an investment. It should reflect the richness of the investment, typically measured by the volatility of cash flows, and must take into account the financing mix. Managers may use models such as CAPM or the APT to estimate a discount rate appropriate for each particular project and use the weighted average cost of capital to reflect the financing mix selected. A common practice in choosing a discount rate for a project is to apply a WACC that applies to the entire firm, but a higher discount rate may be more appropriate when a project's risk is higher than the risk of the firms as a whole. Advantages of NPV. 1. It considers the time value of money. 2. It is an absolute measure of return. 3. It uses cash flow and not profit. 4. It considers the whole life of the project. 5. It leads to selection of projects that increase shareholders' wealth. Disadvantages of NPV. 1. It is difficult to explain to managers. 2. It requires knowledge of the cost of capital. 3. It is relatively difficult to calculate. Internal rate of return. The internal rate of return, IRR, is defined as the discount rate that gives a net present value of 0. It is the special rate of return that will produce break-even NPV, or a discounting rate that will equate discounted cash inflow with discounted cash outflow. It is a commonly used measure of investment efficiency. To calculate IRR, You will calculate two NPVs for the project at two different costs of capital, such that one NPV is positive while the other is negative. You may have to try different costs of capital to calculate these two NPVs. You can then use the formula below to estimate the IRR. IRR equals R with the lower interest rate plus NPV associated with the lower interest rate divided by bracket NPV with higher interest rate minus NPV with lower interest rate times R with higher interest rate minus R with lower interest rate. A rule of thumb is to start with a discount factor that is 2/3 of ARR. The decision rule is to select projects whose IRR is higher than the discount rate, or for mutually exclusive projects, accept the one with the highest IRR. Advantages of IRR: 1. It considers the time value of money. 2. It is a percentage and therefore easily understood. 3. It uses cash flows and not profits. 4. It considers the whole life of the project. 5. It leads to selections of projects that increase shareholders' wealth. Disadvantages of IRR: 1. It is not a measure of absolute profitability. 2. Interpolation method only provides an estimate of IRR. 3. It is relatively complicated to calculate. Relative cash flow. The only cash flows that should be taken into consideration in capital investment appraisal are the relevant cash flows, which are futuristic, incremental, and cash-based. Future cash flows are those that will happen in the future as a result of the project. They are incremental costs because they will arise only if the capital project is undertaken. You should ignore sunk cost, committed cost, non-cash items, and allocated cost. Some costs are costs that have already been incurred. For example, suppose a company makes a non-refundable deposit as a down payment for an item of equipment and then reconsiders whether it wants the equipment after all. The money that has already been spent cannot be recovered and so is not relevant to the current decision about obtaining the equipment. Committed cost is a cost that will be incurred anyway, whether or not the project is undertaken. Example is fixed cost. Non-cash items are not relevant because they are not cash expenditure. Example is depreciation. Net present value versus internal rate of return. The IRR method will result in the same decision as the NPV method for independent projects in an unconstrained environment in the usual cases where a negative cash flow occurs at the start of the project, followed by all positive cash flows. A project is said to be mutually exclusive if the acceptance of one project automatically excludes the acceptance of one or more projects. In the case where you must choose between mutually exclusive investment, the NPV and IRR methods may result in contradictory indications. This is the decision rule of taking the project with the highest IRR may select a project with a lower NPV. In some cases, several zero NPV discount rates may exist. So there is no unique IRR. The IRR exists and is unique if one or more years of net investment are followed by years of net revenues. But if the signs of the cash flow change more than once, there may be several IRR. In general, conditions under which contradictory ranking can occur include projects that have different life expectancies, projects that have different size of investment, projects whose cash flow differs over time, e.g., the cash flow of one project increases over time while those of another decreases. Summary. In this study session, you're exposed to the net present value, NPV, which is the value obtained by discounting all cash outflows and inflows of an investment opportunity by a chosen rate of return. The NPV decision rule is to accept all positive NPV projects in an unconstrained environment, or if projects are mutually exclusive, accept the one with the highest NPV. We define the internal rate of return IRR as a discount rate that gives a net present value of zero. The only cash flow that should be taken into consideration in capital investment appraisal are the real cash flows, which are futuristic, incremental, and cash based. You should ignore sunk costs, committed costs, non-cash items, and allocated costs. Sunk costs are costs that have already been incurred. In some cases, several zero NPV discount rate may exist, so there is no unique IRR. The IRR exists and is unique if one or more years of net investment are followed by years of net revenue. But if the signs of cash flow change more than once, there may be several IRR. This is the end of study session 9. Thanks for listening.